Now it's time to buckle up for CPI and once again, what Nick T just said. Yes, Nick T, the boy that we call Nicky Leaks, because somehow he just always knows what the Fed is up to, and so we listen to him like a hawk. I wonder if the Fed has calls on the Wall Street Journal. I don't know, but they always seem to have the answers. Now, what do we have for CPI projections? And then what did Nick T just say? Well, number one, CPI comes out this week. So there are actually quite a few catalysts this week, and I want to read off some of the expectations for you. But on the 13th, we are going to get our CPI read. We are looking at a CPI read month over month of 0.6%. That's pretty substantial. One of the reasons it's so substantially high is energy prices have gone up. They've gone up quite a bit. We're already at about 54 estimates right now. So the numbers that I'm giving you are a consolidation of roughly 54 estimates. And these are from different banks. This is like your Barclays, your Bank of America. It's also from researchers like Bloomberg, Morgan Stanley, JP Morgan, whatever. Visa's even in here with a CPI estimate. And I always think that's really incredible because Visa is watching consumer credit card spend and such. And so, they kind of see what's going on. It's like, oh, those apples, cost a little less last month, right? Anyway, so all these estimates combined, we're looking at CPI, a core month over month coming in at just 0.2%. We actually believe that 0.2% could be as low as 0.16 to potentially 0.18%. And we'll see what actually ends up coming out. But anyway, 0.2 would be the rounded number for core. CPI year over year actually expected to accelerate from 3.2 to 3.6%. Again, heavily the result of energy prices. Natural gas making up somewhere around natural gas and gasoline combined, making up about 60% of the energy component is driven by gas. And gas has gone up. So it's problematic. It's problematic to see gas prices up like this. And gas prices and oil prices going up do also do something known as tightening financial conditions, which the whole purpose of raising interest rates is tightening financial conditions. So financial conditions are already rising because energy prices are going up. You actually have this potential for the Fed saying, look, we definitely need a pause in September. That's basically clear. But that they might actually even be done because energy prices have financial conditions as tight as we had this sort of little double peak here recently at the beginning of August as energy prices were rising. They went up to roughly about 100 Goldman Sachs Financial Conditions Index. It's at roughly 100 now, 99.93. You kind of have this weird little reverse head and shoulders pattern recently. But if you go before that, we weren't at these levels since May or right before the banking crisis. So these are higher levels of tightness. We were a lot less tight in terms of financial conditions the end of May, June, July, April. So things are tighter now. And we expect the Federal Reserve to respond to that. We'll look at some of this Nick T talk in a moment about that. CPI core year over year expected to come in at 3.6. That's up from 3.2 in the prior. That's the non-core number. And then core year over year, we're looking at, again, that 4.3, down from 4.7. So core shrinking again, great. The day after that, on the 14th, we'll be getting retail sales. We're looking for retail sales to pop up just 0.1%, way softer than the 0.7% we had in the prior month. And if you exclude autos on a month-over-month basis, we expect to be at 0.4 versus the 1% we had previously. Again, way softer. Then we're expecting PPI. This is your producer price inflation numbers on the 14th. The 14th is PPI, PPI data release day. It's also the day before the coupon expiration on the 15th. Link down below for the programs on Building Your Wealth. Massive expiration. Stocks and Psych most popular right now. Zero to Millionaire Real Estate most popular bundle with this. We're finally bringing back our big box partnership to course members as well. And in order to get into the early part of the House Hack fundraise, maybe the only part of the House Hack fundraise, you got to be a course member. So check out those links down below. Big expiration this Friday. So PPI is expected to come in at ex food and energy 0.2 versus 0.3 prior. PPI month over month, non-core expected to be 0.4 versus 0.3 prior. You've got ex-food energy trade expected to be just 0.2%. We really want to see those numbers come in to 0.2%, especially if the average is below that, which it likely will be. The average is likely to be somewhere around 0.16, 0.18, which actually, if you then annualize that figure, all you have to do, you don't have to go exponential here. You take let's take the average of that and go 0.17, for example. We multiply that by 12, and you're essentially at 2% inflation, 2.04. It's the same thing as basically being at 2% inflation. That's what the Fed's looking at anyway. We know that mean inflation trends have been trending towards 2% already. We mostly expect inflation trends to be moving right towards 2%. The concern is, will these higher energy prices unanchor some of these core prices, core services? Obviously, TBD. A lot of uncertainty around turns in the business cycle. Then we'll get University of Michigan consumer sentiment estimates, expecting that 1-year inflation target to still remain 3.5, and 5 to 10 year to be around 3%. And then a couple weeks from now we'll be back at a Fed meeting. Actually, less than that. It'll be on the 20th. So we're about 9 days away from the next Fed meeting. So those are big. Now, what does Nick T tell us? Let's go ahead and jump on over here to Nick T's latest. Nick T's tweet, which is loading right now. There it is. Fed officials are turning more cautious. All right, we'll let that load right there. Here we go. Fed officials turning more cautious in the path towards their final rate hike. That's going to be a big deal. We're going to go through the article on this. Turning more cautious about raising rates too high now that inflation is finally showing signs of rapid declines that they long anticipated. A rate pause in September will give the Fed more time to see if recent progress has continued. Yes, let's go ahead and look at some of these details. By the way, yesterday was the 10th. It was my dad's birthday. Happy birthday, Dad. All right, so take a look at this. For more than a year, Fed policymakers were unanimous that they would rather raise rates too much than too little than too later. Listen to this. This is changing. Ooh. Some officials still prefer to err on the side of raising rates too much, reasoning that they could cut them later. Now, though, other officials, which could actually be more or the majority of officials, other officials, quote, see risks as more balanced. They worry that raising rates and causing a downturn that turns out to be unnecessary or triggering a new bout of financial turmoil or black swan, basically, would be unnecessary. In other words, they have to consider the human cost of their decisions. Why would you lead to people losing their jobs and business bankruptcy if you don't have to? If inflation is indeed transitory, why destroy the market? And that's been the biggest bear argument for the past year, is that the Fed is going to overdo it. That is a risk factor. It still is. But Nick T is telling us, hey, wait a minute, we might have a chance here to just be done. The shift towards a more balanced bias on rates is driven by data showing easing inflation and unusually rapid increases, or as a result of the unusually rapid increases of rates that we've seen over the last year. The bigger debate is what would prompt them to raise rates again in November or December. In June, most officials projected that they would need to raise rates by another quarter point this year. Projections to be released at the end of September. This is September 20th. We're going to be getting the CEP again. It's a big deal. It's going to be a big Fed meeting. CEP, the Summary of Economic Projections, right? Big deal. But anyway, whether they deliver such an increase is open to question. For the past year, officials have placed the burden of evidence of a slowing economy to justify pausing rate increases. As inflation cools, the burden has shifted towards evidence of an accelerating economy to justify higher rates. But it's not just an accelerating economy. If people really forget this, and I really want to remind you of this. Yes, there's a coupon code this Friday. You can email us at staff@meetkevin.com if you need a bundle. But what I really want to remind you of is, remember, folks, it is not an accelerating economy that's the problem. An accelerating economy is okay. It's an accelerating economy where inflation is de-anchoring. As long as inflation doesn't de-anchor, continue to go up, or go up again, rather, I should say. As long as that doesn't happen, you can have a strong economy. Because what does a strong economy do? It provides more employment. For whom specifically does it provide more employment? Well, historically, it provides more employment towards lower income individuals. This has been a little bit skewed because of COVID, and there have been a lot more blue-collar jobs and service jobs than there have been white-collar jobs. So you've had this sort of weird dynamic now. But usually the Federal Reserve is highly sensitive to offending the growth of basically poorer individuals being able to participate in a good economy. It wasn't until about 2018 that Jerome Powell's like, we finally see a more broad-based income demographic benefiting from a strong economy. And then COVID hit and ruined everything. So this is something they're definitely paying attention to. And that human cost matters. Matters a lot. Let's keep going. For the past year, officials have placed the burden of evidence of slowing inflation. Okay, but inflation has started cooling. Recently described that firmer than expected economic activity could basically slow progress on inflation. But he's using the word could instead of would. And this is basically a flip-flop to argue that, like, hey, maybe what I just described, a strong economy does not necessarily mean higher inflation. One camp of officials is still anxious about the increase in inflation and wants an insurance policy by raising rates this fall, which is also kind of interesting because that's one place you're still seeing inflation go up is insurance. That doesn't have anything to do with what really Nick T is saying here right now, but insurance prices have been going up a lot, so much so that some homeowners are just not having insurance at all anymore. They're just self-insuring, which is very risky, especially in places like Florida. Just looking at real estate in Florida. I grew up in South Florida. Anyway, over-tightening is a risk, but we've been underestimating inflation. Allowing inflation to be up for longer does carry a cost for the economy. If it turns out such an increase had more of a negative impact than expected, I'd be more willing to cut the rate a little bit faster. I don't think one more rate hike would necessarily throw the economy into a recession if we did feel that we needed to do one. Right. So skipping doesn't necessarily imply stopping, higher for longer, blah, 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 blah. Okay, I want to be very clear. While they argue they're at the fine-tuning stage, there's a psychology to being at the fine-tuning stage. You could literally think at the Fed, we're done, that we've done enough. And you would, guess what you would still tell Nick T in the world? Hey, we might do one more. They're keeping that door open. Of course, because as soon as they say we're done, you're going to see a big fat rally in the stock market and big fat collapse in treasury yields, and that'll instantly loosen credit conditions and financial conditions. What's actually wild right now is that while oil is falling in the pre-market, and stocks are actually green in the pre-market, look at that 10-year. 10 years up another 3.4 bips. People really think the Fed's not done yet. So the Fed is done, that yield comes right down. So it's pretty exciting. It's exciting times. It's the turn of the eco cycle here, and Nick T is somewhat suggesting that this could be it. It could be done. That the Fed might be back to considering the human cost of rate hikes. And Nick T, after all, is the as we call the Fed whisperer. As far as inflation numbers are expected to be benign here in 2 days. It'll be big, though, because if the estimates are wrong and it comes in hot, we'll start penciling in that rate hike for November, December. We'll probably still get the pause in September, but November, December, we'll definitely price that in. Right now, by the way, it's worth looking at some of the recent numbers that we have for the terminal rate, and we'll also look at the 5-year break-even and 5-year forward. So right now, the Fed term rate's expected to be about 5.44. It's been pretty stable. Again, 5.37 implies the Fed's done. So any number above that, getting closer to 5.625 is a limit. 5-year break-even's up at 2.3%, a little elevated, and a little elevated on the forward break-even as well at 2.35. 2.3 and 2.35 for these two numbers for the 5-year breaks. So I think CPI will really affect that in 2 days. So buckle up for CPI, and of course, the expiration of the coupon code this Friday. It'll be a big one. Be the last chance to get into not only those big box retailer discounts with a company similar to Home Depot, which name we didn't mention until you're in the course. It's coming out later this week. And then, of course, being able to invest in HouseHack, potentially being the last opportunity to invest in HouseHack as a course member. Course members exclusively only to start with. And if we fully fundraise with course members, then that's it. Last time we raised, I want to say it was somewhere around 80+% of all of the fundraising that we did from accredited investors, was course members. What does that tell you about the level of wealth of course members? It's actually pretty impressive. People are looking for real perspective, not some of the basic perspective that's out there on the internet. So thank you for entrusting me in that. Similar thing we're actually seeing with StackHack. Higher net worth of people coming to us with real problems to help us solve for financial advice at StackHack. All these things are linked over at meetkevin.com. You can see them all there. Like this little thing at the top. You can click on it, shadowing, StackHack, and all the other stuff. So anyway, we've obviously covered the complete consensus of forecasts, and we'll discuss those in more detail. But most importantly, we want to highlight Nick T, our Fed whisperer, Mr. Nicky Leaks. Wall Street forecasters expect August CPI to show headline rose 0.6 in July, boosting the 12-month rate to 3.6 from 3.2 thanks to energy prices. Remember, gas generating around 60% of that headline movement. They see core CPI up 0.2%, lowering the 12-month rate to 4.3 from 4.7 in July. And these are some of the breakdowns over here of that core level. Look at those core estimates. I mean, the highest one over here is 2.5, or well, 0.25. But a lot over here, 0.15, 0.18. This is where I lean over here, in this lower area, 0.14.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.